All right, sir, let's get into our discussion proper now. Now, the Nigerian Extractive Industries Transparency Initiative, NEITI, has expressed concern over Nigeria's level of indebtedness, declaring that Nigeria's debt in relation to revenues has reached an alarming levels. But let me go to my wall and then let's see some other figures in there before we come back to discuss. Our guest is already seated and we will get to understanding these things better. Now let's hit this and understand things better. Now, these are some of the figures we'll be tinkering with. According to NEITI, a total of 513 billion naira was spent on debt servicing by the three tiers of government in the first quarter of 2017, out of 1.27 trillion naira disbursement from FAC in the aforementioned quarter, representing 40.3% of the total sum. So have that at the back of your mind because we're taking it bit by bit. Now, NEITI disclosed that the federal, states and local governments shared 2.79 trillion naira between January and June 2017, representing about 38% increase on the 2.02 trillion naira shared in the first quarter of 2016. Now, out of 2.79 trillion, the federal government received 1.09 trillion naira. 36 states and the federal capital territory received 923 billion naira, while 547 billion naira went to all the local governments in the country. 774, well, with the seeding of Bakassi, I wonder if we still have 774. I think the number has reduced from there. Now, let's move on. Now, but despite the 38% increase when compared with 2016, the three tiers of government suffered significant revenue decline. This is due to unstable oil price in the global market, coupled with difficulty in meeting the targeted production rate of 2.2 million barrels per day. Now, production has steadily fallen below 2 million barrels per day since March 2016. This reflected in the FAC's disbursements. Now, while the expected income was 4.7 trillion naira, amount received and shared was 2.79 trillion naira, representing a shortfall of about 1.91 trillion naira, and that's about 40.60 or 40.67%. Okay. Now, going ahead with some of these figures, we see that the drastic drop in the country's earning that has heightened the federal government's borrowing plans. And the borrowing is what Nigerians have been complaining about day in, year out. Now, according to the Debt Management Office, Nigeria's indebtedness to creditors, local and foreign, rose from 17 trillion naira recorded at the end of December 2016 to 19.16 trillion naira as at June 2017, representing an increase of 1.8 trillion naira. Now, according to the DMO, that's the Debt Management Office, Nigeria's external debt now stands at 4.1 trillion naira as against 3.9 trillion naira at the end of December 2016. But the domestic component of the debt fell to 11.97 trillion naira as against 13.88 trillion naira as last year. Now, let's move on to understanding some of these figures better. Now, Lagos State has the highest debt profile of 603 billion naira of all Nigerian states in 2016, as against its revenue of 410 billion naira. Delta State is the second. Delta State there in the south of Nigeria is the second state with the highest debt profile of 332 billion naira. Its revenue stands at 142 billion naira. Now, Yobe State and Anambra State stood out, let me say, as at the records, when the records were made, stood out as the states with the least debt burden, while Yobe was indebted to the tune of about 11 billion naira. Anambra State has a debt profile of about 20 billion naira. So, two extremes at the top and two extremes at the bottom. Let's move on. The International Monetary Fund has warned that Nigeria's debt to GDP ratio will hit 24.1% by 2018. By the end of 2017, Nigeria's current indebtedness would have reached 23.3%. As at December 31st, 2016, the ratio was 18.6% and 12.1% in 2015, if we make comparison between that year and the previous year. Now, by IMF's projection, Nigeria's debt-to-GDP ratio would have surged by 100% from 12.1% in 2015 to 24.1% in 2018. Now, all of this spell doom for Nigeria's economy, which is still grappling with recession. So what's the way forward? That's the big question we are asking right now. Okay. As I said, I wonder...
It's alarming and it's quite worrisome, and that is why NEITI is sounding the alarm right now that Nigerians should be aware, and the federal government, even the states and local governments should be aware. But we have joining us to discuss this an economist, Tilewa Adebajo. Good morning to you, and thank you for joining us.
Good morning. Nice to see you.
Yes,
how are you?
Fine, thank you.
Fine.
So what is your immediate reaction to the report and the alarm sounded right now by NEITI?
Well, I think it's a very valid assessment of what has happened, and I think it's a very important warning. But we must realize that in March, during the Article 4 consultations, the IMF already flagged the fact that we're now spending close to 66% of our revenues servicing debt. And that was a big red flag that I think has been sounded by the IMF since March of this year. Let's take a look at the facts as you have provided, and let's try to summarize that fact, the facts and figures you've provided. Our debt profile now is about 65 or 67 billion dollars, which is equivalent to about 19.2 or 19.5 trillion naira. Of that amount, the states contribute to about $10 billion of that, or $10 billion of that amount of money. Our external debt is about $13 billion, and our domestic debts are at about $40 billion. So that's the summarization of the figures that you have excellently provided us. So the concern really is the fact that at that level, it's no longer sustainable. If you're using 66% of your revenues to service debt, then you do not have that much space to be able to pay salaries and do the capital projects. Now, what has been the genesis of this? The problem is the fact that we're in a recession, and the government has already for the first time in a long time, we have a deficit that we're trying to finance. So we've carried over a 2.2 trillion deficit from last year into this year, which is about 4 or 5 trillion naira in deficit financing that we have not fully resolved. The challenge the finance minister has is the fact that the domestic debts are attracting some very high rates of interest, which you can see is now being reflected in the cost of debt service. And the challenge they're having is the fact that last year they had a successful outing at the Eurobond markets because borrowing in dollars is quite cheaper than the 22% or the 18% average we're paying on the domestic debts. So this is really where the challenge is now. And as you can see from what the minister is trying to do, they're now trying to swap out some of those domestic debts from naira into dollars to be able to reduce the cost of borrowing. But you also have the impact of the macroeconomic situation with inflation. Because we have a recession and we have this cost push inflation, which has been quite stubborn with keeping the levels of inflation high. The central bank on the monetary side, you see, will try to prevent the value of the currency locally, especially for investors, because you don't want the savings rate to be lower than the rate of inflation because you are destroying value. So the central bank governor will want to keep rates high, above inflation rates, to be able to provide value for investors in those instruments. So that's the dilemma we face now, because we're trying to balance the monetary and the fiscal policy. So that's the classical case of misalignment between fiscal and monetary policies. So those are the challenges the government is facing right now, and we have to address them head on.
All right, from that economic point of view and perspective, all the borrowings we've been doing all the while that we've become this indebted, has there been economic justification from what you see and from what you analyze and assess?
you have raised a very, very important point. The problem is that we have been borrowing money to pay salaries and all the other recurrent expenditure. We have not been borrowing to invest in capital projects where you begin to see dividends. If you had been borrowing and making investments in capital projects, you could have seen a value in terms of the sort of returns you would have over time in terms of infrastructure development and the sort of benefits you can see from that. Because the challenges with fiscal policy management and the rising levels, but not only with the federal government, but also with the states, they can hardly pay salaries. So if you cannot pay salaries, how do you put money into capital projects for investment? The Vice President made a very important point yesterday where he said they had tried to spend 1.7 trillion on capital projects, but that was not the budget for capital projects. While it might have been a good attempt, I think probably one of the best attempts on record to be able to improve capital expenditure, we're not there yet. And the reason we're not there yet is because we're in a recession. And the whole essence of this deficit financing was to be able to create the necessary stimulus to get us out of the recession. But unfortunately, because of the government's inability to be able to raise the necessary debt to finance that deficit, we have not seen the desired effects in terms of the stimulus and the growth that we require. Now, the IMF predicts that we're going to grow by 0.8% this year. People are talking about the recovery, but in all honesty, the recovery is not there. While the trajectory on GDP growth has probably eased off and we're now looking at it gradually beginning to come up, we're still in negative territory. The population of Nigeria is growing about 3.2% per annum. If your economy is growing at 0.8%, then we're in trouble. So these are the sort of challenges and the sort of levers that the government now needs to be able to adjust, to be able to fine-tune the monetary side, to be able to make sure that the stimulus is coming not only from the macroeconomic policies, but the macroeconomic policies are in line with the monetary policy, which is controlled by the central bank, and you can get some relief to the finance minister on the fiscal side in terms of managing recurrent expenditure and, more importantly, making the investments in capital expenditure.
All right, so should the country at this point seek debt relief? Because it seems that what the government can do is just to service the enormous debts. Well,
we're no longer at a point of debt relief, and I think that there are laws in this country which we have, which is called the Fiscal Responsibility Act, which prevents the government from going beyond certain limits. So those are statutory. It's the law that the government cannot manage its finances beyond a particular point. So there are boundaries that the government has. We haven't got to these boundaries yet. But one of the key decepting factors which we see is this issue of debt to GDP ratio. Now, the debt to GDP ratio, as you can see from your graphs, has gone up in 2015 from 12% now to about 23%, which shows rising capacity for debt. But it can be deceptive because while you have a debt to GDP ratio of 23%, the most important thing is your ability to pay back. With 23% debt to GDP, you feel you have some headroom, but we don't anymore, because our debt service, because of declining revenues, is at 66%. I'll give you an example of the United States. The United States of America has probably maybe $20 trillion in debt. The debt to GDP ratio is 104%. But the US government spends only 8% of its revenues to service its debt. But the US government spends only 8% of its revenues to service its debt, compared to what we're doing at 66. So the key ratio we should start to focus on is our ability to pay back this debt, which is really what is important, because the challenge we have in our economy today is that we do not have confidence. We do not have the stimulus that will drive that growth out of the recession. And as we've told you, the minimum amount of growth that we require is a minimum of at least 4%, which must be over the population growth.
Okay, now from all of the policies and all of the strategies put in place for us to get to that level, the recession has really hampered that growth from at least putting it bare for people to understand. But the governor said we'll try to spend our way out of the recession.
Yes.
But if you spend your way, it implies that there's going to be excess liquidity or more cash in the economy. Now, how does that impact on the inflation? And we are trying to prevent inflation so that we can actually have the right amount of money and the right amount of policies to get out of recession.
Thank you very much. That's a fantastic question we're looking at. Inflation has its benefits. And when you want to inflate the economy, the classic inflation you're talking about is too much money chasing too few goods. We don't have that yet in Nigeria. The inflation we are talking about is the issue of demand pull inflation, which is what we're looking for to try to reflate the economy so that you can stimulus spending. That's what we're looking for. The inflation we have now is what you call cost push inflation, which is being caused by the increase in food prices, the removal of the subsidies, which is what is driving that inflation. So when you have a cost plus inflation situation, that is not desirable for now. What we're looking, the right type of inflation we're looking for is that too much money chasing, we have not gotten to that stage yet of too much money chasing too few goods, because you can see that the demand and I think the ability, the consumer confidence and the spending power and the disposable income of Nigerians have shrunk. So people are making choices whereby that confidence to be able to spend is not there. And as you've seen, the government has not been able to raise the necessary money to fund this deficit. So if the government cannot fund this deficit to raise financing, it becomes a problem. So after 2 years of this administration, the sort of stimulus we're looking for is not there. So the earlier the government gets its fundraising exercise together and push this money into the system, the better it is for everybody. So the system they're trying to use now to swap this domestic bonds into dollar-based to be able to reduce the cost of borrowing, we need to get it out of the way quickly. There's demand for these instruments. The last Eurobond offer was oversubscribed. So at that point in time, you should have gone to the market. You're gone to the markets, you're coming back to the markets. It doesn't send a very positive signal. Get the act together, understand what you need, go to the market. We can get 3, 4, 5 billion from the market easily. If that's what we want, let's go get it. We have a debt profile of 65 billion. If you want to swap most of it into dollars, go ahead, do it. But, you know, we need to create the stimulus to get the economy going.
All right. Now, one of the major causes of this is the decline in revenue of the country and, of course, the slump in the price of crude. But then at the moment in the country, there is this new trend of the attractive trend of investing in treasury bonds and then at the detriment of FDIs. For a country that wants to make money at all costs, what should be the strategy now?
Well, the strategy should be a balanced approach in terms of setting up the economy straight. Most of what you've seen in terms of how the economy was managed and the course of this recession, in my own opinion, was not as a result of the oil price. It was a result of economic mismanagement and focus primarily from the central bank and the managers of the economy. You send the wrong signals to the international community, they react, and now with the NAFEX window, we've now, 2 years later, I think where all the things they'd asked us to do, we're now doing it. So basically, what we have in place now are the right policies, the right environment, and what we need to do is to instill confidence in these investors, both primarily local investors and of course the foreign investors who are coming in, to be able to have the confidence to begin to make their investments to keep things going. So all the policies, everything is in place. What we need now is the issue of confidence. Confidence is something that people tend to underestimate. But confidence tends to be things from signals. The president is back. He needs to make key statements on the economy to tell us exactly what he has in mind. And these sort of signals will be able to send the sort of, you know, confidence to investors, primarily local investors, to be able to move forward with their expansion plans. And once they begin to expand and confidence returns, then of course the foreign direct investors will also come through. But right now what you're finding is the portfolio investors who are opportunistic. They see a return with our rates on our treasury bills, and the NAFEX window is there for them, will come in.
Just take advantage of it.
Yeah, that is what it's, and you will do the same, because you don't want to save your money to lose money.
Money, exactly.
If you have if I give you various options of investments today, which investment would you take? You go for T-bills at 22.
Exactly.
We all will. So, and this is what we need to realize, that, you know, we're all investors and we're all players in this economy.
Okay. Now, what's the impact of having the multiple foreign exchange rates that we have in the country? What impact is it having, or is there any link between it and our inability to pay our debts, or because we translate everything into dollars and all of that? What's the link?
Well, put it this way, we do not have a problem with paying our debts. I think that should be clear. Oil at 50 barrels, you know, most of our income we're making is in dollars from the sale of oil. So the ability to finance our local debts and our domestic debts is not in question. The sustainability of our debt profile is not the issue. It's just that profile. So to answer the question that you posed to me directly, what needs to be done really is the fact that you need to focus on effective management, look at those indices properly, manage it, and send the right signals to the financial markets.
All right. Do you think either valuation or devaluation of Naira would help the economy in any way instead of spending Nigeria out of recession? Well,
the issue again with the foreign exchange is the fact that we have actually gone through a devaluation within the last 2 weeks that a lot of people have not known.
Unofficially.
Well, it's what we might call a stealth devaluation. These multiple exchange rate systems, we need to harmonize it and get it into a single system, because it's causing a lot of distortions. The NAFEX window has been quite good in the sense that you're seeing that the trades and the platforms for the bid and offer system, but unfortunately the banks are not disclosing their bid rates and their offer rates. It's important that we have transparency in this market. And the question you raised earlier on the foreign exchange, if we have transparency within the NAFEX window and the current platform, FMDQ platform that we're trading, and we have transparent bid and offer rates, there's no need for multiple rates. Then the government might decide they want to give their own rates, but in terms of market-determined rates, the systems are in place to have that work. But the central bank should let the markets play a role, so that once you have that, then there's no difference between the black market or the NAFEX window, and people can go in there and make their quotes on this rate, and everybody has one rate.
Okay. Now to the layman, if you have a savings account in 2 different banks and you're making profit into one and you're owing the other bank, one would expect that the profit you're making should go straight into the bank you're owing so you can balance up. We have our foreign reserve, you know, appreciating gradually and all of that. And we still have the debt profile increasing. Would it make any economic sense to say, okay, whatever profit we have, we put it into our debt so we can get, or at least sign off some of the debt we have?
Not really. Okay. I think debt is a very powerful financing tool. And it's a question of how you optimize debt within your capital structure and the country's balance sheet. As you've said, you have the reserves. It is the balance sheet and the power of our balance sheet that we're able to leverage to be able to raise debt. The question you raised earlier is the fact that what are we spending this debt on, or what have we spent the $65 billion that we owe on? If we had invested a significant portion of that $65 billion on infrastructure, then we can see the benefits over time. And that is why the government is trying to go for these concessional World Bank loans at maybe 0.5% over 30 years. So it's really the question of the way you have optimized debt within your capital structure. And if you use debt properly for the right things, then you'll get the benefits. But if we continue to use this debt to pay salaries and recurrent expenditure, then we have a problem of repaying over a longer period of time without the inherent or intrinsic value.
All right, should the country continue to borrow? Because I'm asking this question because you see that some states kind of do not even have any economic base. Some just go cap in hand to the federal government to get something every month. So how is it going to be for states that, for example, like Osun State now, that is mired in debts, one of the top countries in debts alongside Delta and Lagos, to be able to raise revenues by itself, and then the country and the states do not go outside, especially to keep borrowing money?
Well, like I told you earlier, everybody, including Nigeria, every state, including the federal government, has a debt limit. When you reach that debt limit, you'll find out that you can't borrow anymore, or nobody will borrow you anymore. So by the time the federal government is using 66% of its revenues to service debt, then that tells you that, you can't borrow anymore. It's not sustainable. So you have to stop. So there are two things you can do. Either you increase your revenue profile, which is what the government is trying to do by trying to increase taxes and trying to diversify the economy. So until we do that and we increase our revenue profiles to be able to reduce our level of debt service to maybe 30%, then we can't borrow anymore. So it's very clear. A lot of all these states you've mentioned, they also cannot borrow anymore. Osun State is on the extreme. It's a state that has been totally mismanaged, and you find a situation whereby nothing can work anymore. States like Lagos, Delta, and Kano, for instance, have the revenue profiles to be able to justify the sort of debt levels they're carrying. So there's not a problem there. So these are the sort of things that we need to see. And like I said, the federal government has a Fiscal Responsibility Act. I think what is important, that act guides the government and makes sure that we cannot borrow beyond what we can afford. So those guidelines and checks and balances are there. My problem is that the federal government should have insisted, when they gave the states the bailout fund, for each state to enact a Fiscal Responsibility Act. So those states don't have those guidelines, and I think that is why you see more of the reckless borrowings in the states.
All right, economist Tilewa Adebajo, thank you very much for coming on the program.
Thank you for having me.
Thank you so much.
Have a nice day.
Right.
Thank you.